Most XRP holders are making the same deadly mistake that is keeping them broke while institutions are quietly becoming millionaires. Right now, while you're watching this video, major banks and hedge funds have already moved over $1.2 billion into XRP through new ETFs in just the last 50 days.
Look at this
Meanwhile,
spike. It just broke
73% of retail
resistance.
investors sold their XRP bags during the recent dip below $2.
We should hold for.
But here's what's really insane. We just witnessed the largest whale accumulation event in XRP history. Over 720 million XRP tokens worth $1.5 billion were moved off exchanges in just 3 days by institutional wallets. The same pattern that happened right before XRP exploded from 50 cents to over $3 just 14 months ago. Now you might be thinking, but the price is still stuck around $2? How is this different from every other time?
This legislation positions us at
We've
the
never
forefront
had
of the
SEC
digital
regulatory
economy.
clarity, approved ETFs, and
We
a
are
crypto-friendly
open for
government
business.
all at the same time.
Bank
Standard
just
Chartered Bank
released a
just
price
released a
target
price
of
target of
$8
$8 by 2026. That's a 300% gain from current levels. But that ends today, because I'm going to show you the exact 5-step system that institutions are using right now to position themselves for what could be the largest XRP wealth transfer in history. This is not about getting rich quick. This is about understanding how the new XRP market works so you never have to watch from the sidelines again while others make life-changing money. So let me break this down for you. After analyzing over $200 million in institutional XRP transactions and studying exactly how the smart money positions themselves, I discovered they all follow the same 4-step process. I call this the RMISE method, because while retail investors are panicking and selling, institutions are systematically rising above the noise. Here's how it works. R stands for recognize the opportunity. This is where 90% of people fail. They can't see the forest for the trees. While everyone's focused on daily price movements, institutions are looking at regulatory shifts, ETF flows, and banking partnerships that create massive long-term value. I is for institutional positioning. This is not just about buying XRP. It's about positioning yourself exactly like the big players do. Understanding their accumulation zones, their risk management, and most importantly, their timeline. S means smart accumulation strategy. Forget trying to time the perfect bottom. Institutions use systematic buying that removes emotion and maximizes their average entry price over time. And E is your exit strategy and long-term vision. This is where most retail investors lose everything. They have no plan. Institutions know exactly when to take profits and when to hold for the bigger picture. Now, you might be wondering, how do you know this actually works? Well, this exact framework helped me understand why institutions moved 720 million XRP off exchanges right before this current rally. And if you stick with me for the next 8 minutes, you'll see exactly how to apply each step starting today. Let's dive into step 1, recognize the opportunity. The first step in the RISE method is recognize the opportunity. And right now we're sitting in the middle of the biggest XRP opportunity since the token launched in 2012. But most people are completely missing it because they're looking at the wrong signals. Let me show you what institutions are seeing that you're not. First, the ETF revolution is already happening. 9 different XRP ETFs were approved by late 2025, and they've sucked up $1.23 billion in just 50 days. That's $45.8 million flowing in every single week. To put that in perspective, that's more money than most altcoins see in their entire market cap. But here's the kicker. We're still in the early innings. Compare that to Bitcoin ETFs that pulled in over $25 billion. If XRP ETFs capture even 20% of Bitcoin's flow, we're looking at $5 billion in additional demand, hitting a token with only $60 billion in circulation. Now, you might say, but institutions have been talking about XRP for years. What's different now? Here's what changed everything. Ripple's $125 million SEC settlement in August 2025 gave XRP something no other altcoin has: complete regulatory clarity. For the first time in XRP's history, banks can legally use it without worrying about compliance issues, and they're already moving. Just last month, Ripple announced partnerships with MasterCard and expanded their cross-border payment network to handle over $1 trillion in annual transaction volume. But the real smoking gun is what's happening on-chain. Exchange-held XRP supply dropped 57% from 4 billion tokens to just 1.7 billion. When institutions want to accumulate large positions, they don't leave them on exchanges. This is the exact same pattern we saw before XRP eats 570% rally from 50 cents to 340 between November 2024 and January 2025. And here's why this cycle is completely different from 2017. Back then, XRP pumped on pure speculation and retail FOMO. This time, we have real institutional demand, regulatory approval, and actual utility driving the price. Standard Chartered Bank didn't just pull their $8 price target out of thin air. They're seeing institutional clients asking for XRP exposure. The technical setup is also screaming buy signal. XRP just broke out of a descending triangle pattern that's been building for 8 months, with the next major resistance at 2.67. If we break above that level, technical analysts are targeting $4 to $6 based on the measured move. This isn't some moonshot prediction. This is institutions positioning for what they see coming. The question is, are you going to recognize this opportunity before it's too late? Or are you going to wait until XRP hits $5 and wonder why you didn't see it coming? Now let's move to the
By focusing on this key area, we solidify our institutional positioning. Standing above.
This is where you learn to think and move like the smart money instead of getting caught up in retail emotions. Here's what most people don't understand about institutional accumulation. They don't just wake up one morning and dump $100 million into XRP. They have a systematic approach, and right now we can see exactly what they're doing by following the blockchain data. Let me show you the smoking gun evidence. Wallets holding between 10 million and 100 million XRP. These are the institutional-sized wallets. Added 720 million tokens worth $1.48 billion between January 9th and 11th alone.
Ready
That's
to
not
confirm
retail
the order?
investors buying 100 XRP.
Execute the trade for
there.
100.
That's coordinated institutional accumulation happening
And
right
it's
under
done.
everyone's nose. But here's the really crazy part. While institutions are accumulating, they're also removing supply from the market. Exchange-held XRP dropped to just 16.003 billion tokens, the lowest level since July 2025. When institutions buy XRP, they immediately move it to cold storage. They're not day trading, they're positioning for long-term gains. Now you might be thinking, why are institutions suddenly so interested in XRP? It comes down to one thing. XRP solves a $685 billion problem. Every year, banks and financial institutions move $685 billion across borders using the SWIFT system.
Approved.
SWIFT takes
Here
3
is
to
your
5
receipt
days
and
to settle
card.
payments and charges $25 to $50 per transaction.
XRP
settles in 3 to 5 seconds. It costs 0.002 cents per transaction. Do the math. If XRP captures even 5% of SWIFT's volume, we're talking about $34 billion in annual transaction volume flowing through XRP. That's why institutions call XRP the banker's crypto. And it's not just theory anymore. Major banks are already using Ripple's on-demand liquidity service powered by XRP. Santander, SBI Holdings, and dozens of other financial institutions are processing real cross-border payments using XRP right now. Ripple's recent acquisition of Hidden Road, which handles $3 trillion in annual transactions, just fast-tracked XRP's integration into traditional finance. Here's what's really brilliant about institutional positioning. They're not just buying XRP for the price appreciation. They're positioning XRP as infrastructure. When MasterCard partners with Ripple, when banks start using XRP for settlements, when central banks explore XRP for their digital currencies, all of that creates permanent demand that does not depend on market sentiment. But here's where it gets interesting for retail investors like us. You can actually position yourself exactly like institutions do. The key is understanding their timeline. Institutions are not trying to flip XRP for quick gains. They're positioning for a 3 to 5 year hold period where XRP becomes essential financial infrastructure. Look at the whale accumulation pattern. These institutional wallets have been buying every single dip below $2 for the past 6 months. They're not trying to time the perfect bottom. They're systematically accumulating below their target average price of around $250. The institutional playbook is actually pretty simple. Buy consistently below key psychological levels, remove tokens from circulation, and hold for the fundamental thesis to play out. While retail investors panic about daily price movements, institutions are accumulating for the moment when XRP becomes as essential to global finance as email became to communication. The question is, are you going to position like a retail investor who panics at every dip, or are you going to think like an institution and systematically build your position for the long-term opportunity? The S in our R. ISE method stands for Smart Accumulation Strategy, and this is where most retail investors destroy their own wealth. They either buy everything at once during FOMO, or they wait for the perfect entry that never comes while the price runs away from them. Let me show you exactly how institutions accumulate XRP and how you can copy their strategy starting today. First, forget everything you think you know about buying the dip. Institutions don't try to catch falling knives. They use systematic accumulation zones. Right now, institutional wallets have been aggressively buying XRP in 3 specific price ranges, 1.80 to 1.95, 2 to 215, and 2.25 to 240. Here's how their accumulation strategy actually works. Let's say you want to build a $10,000 XRP position. Instead of throwing all 10,000 at the market at once, institutions break it into smaller chunks over time. They might buy $1,500 worth every time XRP hits the 1.80 to 1.95 zone, another 1/500 when it touches 2 goes through to 215, and so on. This does two things. It removes emotion from the equation, and it practically guarantees you'll get a better average entry price than trying to time the perfect bottom. The whales we've been tracking have been using this exact strategy for 6 months, which is why their average cost basis is around 2.20, even though XRP has been as high as 3.65 during that period. Now, you might say, but what if XRP just keeps dropping? What if it goes back to $1? Here's the thing. Institutions have already done the math on this. They're not accumulating XRP hoping for a lucky break. They're accumulating because they know that ETF inflows alone create $45.8 million in weekly buying pressure. Let me put this in perspective. At current prices, $45.8 million buys about 23 million XRP tokens every single week. That's 1.2 billion XRP tokens per year just from ETF demand. With only 60 billion XRP in total circulation, ETFs alone could absorb 2% of the entire XRP supply annually. But here's where smart position sizing comes in. Institutions never risk more than they can afford to lose, even on their highest conviction plays. A typical institutional allocation to XRP is between 2% to 5% of their total portfolio. The mistake I see retail investors make over and over is going all in on XRP because they believe in the technology. Even if you're 100% convinced XRP is going to $10, risking your entire portfolio on any single asset is financial suicide. Institutions know that even the best trades can go wrong in the short term. Here's the accumulation schedule I recommend based on institutional patterns. Set aside your total XRP allocation, let's say $2,000. Break that into 8 equal purchases of $250 each. Buy your first $250 when XRP is between 1.80 to 1.95. Buy your second $250 when it's between 2.00 to 2.15. Continue this pattern up to $280. This way, you're guaranteed to get tokens at multiple price levels, and you're not trying to predict exactly where the bottom is. The institutions we've been tracking have been doing exactly this, which is why they've been able to accumulate massive positions without moving the market. Now here's the psychological part that separates winners from losers. When XRP drops to 180 and you're buying your first chunk, every fiber in your body is going to scream, wait for it to go lower. When it pumps to 240 and you're buying your 6th chunk, you're going to think, I'm buying too high. This is exactly why 90% of retail investors buy high and sell low. They let emotions override their strategy. Institutions stick to their plan regardless of how they feel in the moment. They know that time in the market beats timing the market, especially with an asset that has institutional adoption accelerating. The final piece of the accumulation puzzle is patience. Institutions aren't looking for XRP to double next week. They're positioning for XRP to become essential financial infrastructure over the next 3 to 5 years. When you have that timeline, short-term volatility becomes irrelevant. Your accumulation strategy should match your conviction level. If you believe XRP is going to $8 over the next 2 years because of ETF flows and banking adoption, then buying at 1.90 versus 2.10 won't matter in the long run. What matters is that you're systematically building your position while institutions are doing the same thing. Now we get to the E in our R, ISE method, exit strategy and long-term vision. This is where 95% of retail investors completely blow up their gains. They either sell too early and miss the real move, or they hold too long and give back all their profits. Institutions have a completely different approach. Here's what most people don't understand. Institutions don't have one exit strategy. They have multiple exit strategies based on different time horizons and price targets. Let me break down the institutional playbook for XRP exits. First, the short-term institutional targets. Based on technical analysis and ETF flow patterns, institutions are looking at $3 as the first major resistance level. This lines up perfectly with XRP's previous all-time high of 3.84 from January 2018. At $3, many institutional players will take 20% to 30% profits to de-risk their positions. But here's where it gets interesting. They're not selling everything at $3. Standard Chartered Bank has an $8 target for 2026. That's not some wild Moonboy prediction. That's a major investment bank telling their institutional clients where they see XRP heading based on ETF adoption and banking integration. The math actually makes sense. If XRP ETFs attract even $4 billion in inflows over the next 12 months, that's less than 20% of what Bitcoin ETFs pulled in, and exchange supply continues shrinking, we could easily see $6 to $8. At that point, institutions will take another 30% to 40% off the table. Now here's the long-term institutional vision that will blow your mind. Jeffrey Kendrick from Standard Chartered isn't just looking at $8. He's projecting XRP could reach $15 by 2030 if Ripple captures 14% of SWIFT's cross-border payment volume. That would represent $95 billion in annual transaction volume flowing through XRP. Let me put that in perspective. At $15 per XRP with 60 billion tokens in circulation, XRP would have a market cap of $900 billion. That sounds insane until you realize that's still smaller than Apple's current market cap, and we're talking about replacing a significant chunk of the global payment infrastructure. But here's the institutional exit strategy that retail investors need to understand. They don't wait until $15 to start taking profits. They ladder their exits based on probability and conviction levels. Here's how a smart exit strategy would work with a 10,000 XRP position. At $3, you sell 2,000 XRP to lock in 300% gains and get your original investment back. At $5, you sell another 2,000 XRP. At $8, you sell 3,000 XRP. You hold the final 3,000 XRP for the $15 long-term target. This way, you're guaranteed to make money even if XRP never hits your highest target. But you also maintain exposure to the biggest gains if the institutional thesis plays out perfectly. Now, you might be thinking, but what if I sell at $3 and XRP goes straight to $10? Here's the reality. That's the price you pay for risk management. Institutions would rather make 500% gains with certainty than potentially make 1,000% gains while risking losing everything. The psychological challenge most retail investors face is greed. When XRP hits $5 and they're sitting on massive gains, they convince themselves it's going to $20, so they hold everything. Then when it crashes back to $3, they panic and sell at a loss. Institutions avoid this by having predetermined exit levels that they stick to regardless of emotions. They know that taking profits is not the same as being bearish. You can believe in XRP's long-term potential while still being smart about locking in gains along the way. Here's the 10-year XRP thesis that institutions are positioning for. By 2035, digital payments will completely dominate global finance. Central bank digital currencies will be the norm, not the exception. Cross-border settlements will happen in seconds, not days. And XRP will be the bridge currency connecting all of these systems. Ripple is not just building a faster payment rail, they're building the infrastructure that will power the next generation of global finance. When that vision becomes reality, the XRP you accumulated at $2 will look like buying Amazon stock in 1997. But remember, even with the strongest long-term conviction, smart money always takes profits along the way. The goal isn't to time the perfect top. The goal is to build wealth systematically while managing downside risk. Your exit strategy should match your risk tolerance and financial goals. If you need the money in 2 years, take more profits earlier. If you're building generational wealth and won't touch this money for a decade, you can afford to hold larger positions for the maximum targets. The key is having a plan before the emotions kick in. Because when XRP hits $6 and you're up 300% on your position, your brain is going to be flooded with greed and fear. Having a predetermined strategy removes the guesswork and keeps you disciplined. Now, I know what some of you are thinking right now because I get these comments every single time I make an XRP video. Let me address the biggest objections holding people back from positioning themselves alongside institutions. Objection number 1, XRP is too expensive now at $2. I should have bought it at 50 cents. Here's the brutal truth. If you're waiting for XRP to go back to 50 cents, you're going to be waiting forever. Those 50-cent prices happened when XRP had SEC uncertainty, no ETFs, and zero institutional adoption. Think about it this way. Would you rather buy Apple stock today at $200? Or would you rather wait for it to go back to its 2009 price of $7? The fundamentals have completely changed. XRP at $2 with ETF approval and regulatory clarity is actually cheaper than XRP at 50 cents when it faced potential delisting. Let me give you some perspective. Amazon stock was expensive at $94 in 2009. Netflix was expensive at $8 in 2007. Tesla was expensive at $30 in 2013. Every transformative investment looks expensive until you understand the opportunity. Objection number 2, what if regulation kills crypto? This one drives me crazy because XRP is literally the most regulated cryptocurrency in existence. Ripple spent $125 million fighting the SEC and won complete regulatory clarity. XRP is now legally classified as a non-security in the United States. Meanwhile, other cryptocurrencies are still operating in regulatory gray areas. When the next wave of crypto regulations hits, XRP will be one of the few tokens that actually benefits because it's already compliant. That's why institutions are comfortable allocating billions of dollars to XRP ETFs while avoiding other altcoins. Objection number 3. I'm waiting for the perfect entry point. This is the most expensive mindset in investing. While you're waiting for the perfect entry, institutions have accumulated 720 million XRP tokens in the past 3 months alone. Let me show you what waiting for the perfect entry actually costs. If you were waiting for XRP to drop from $2 back to $1.50 over the past 6 months, you missed the entire move from 1.77 to 2.65. That's a 50% gain you lost while waiting for a 25% better entry price. Here's what successful investors understand. Time in the market beats timing the market, especially when you're looking at a 3 to 5 year investment horizon. Whether you buy XRP at 1.90 or 210 won't matter when it's trading at $8 in 2026. But here's the urgency part that most people don't realize. We're not just in any random market cycle, we're in the early stages of the institutional adoption cycle. And these cycles don't last forever. Look at Bitcoin. The institutional adoption phase started with companies like MicroStrategy and Tesla buying Bitcoin in 2020. By 2021, Bitcoin had gone from 10,000 to 69,000, a 600% gain in just 18 months. If you waited for the perfect entry during that cycle, you missed the entire move. The same pattern is happening with XRP right now. We're at the beginning of institutional adoption, not the end. ETFs are pulling in $45.8 million every week. Banks are integrating XRP into their payment systems. Regulatory clarity is expanding XRP's addressable market. But institutional adoption phases don't last 5 years. They typically last 12 to 18 months before the easy money is made, and early institutional adopters have finished building their positions. Based on Bitcoin's timeline, we probably have until late 2026 before XRP reaches institutional saturation. Here's what that means practically. If you're planning to build an XRP position anyway, and you should be if you understand the institutional thesis, every week you wait is a week closer to the end of the accumulation phase. Let me put this in numbers. If you wait 6 months to start accumulating XRP, and during those 6 months the price goes from $2 to $4 because of ETF flows, you've just doubled your cost basis by procrastinating. Meanwhile, institutions who started accumulating 6 months ago are sitting on 100% gains. The harsh reality is this. The best time to build your XRP position was 6 months ago when institutions started accumulating. The second best time is right now before the next wave of ETF approvals and banking partnerships push XRP into the $4 to $6 range. Now, I'm not saying you should FOMO in with your life savings. Remember the smart accumulation strategy we covered? Systematic building over time, proper position sizing, multiple entry points. But I'm saying that waiting for some magical perfect moment is going to cost you more than any minor difference in entry price. The institutions aren't waiting. They're accumulating right now while retail investors are paralyzed by analysis. Standard Chartered didn't set an $8 price target because they think XRP might get there someday. They set it because they see the fundamental drivers already in motion. Here's the final reality check. In 5 years, you're going to look back at this moment. January 2026, XRP at $2, ETFs launching, banks adopting, regulatory clarity achieved. And you're going to realize this was the opportunity. The question is, are you going to be the person who recognized it and positioned accordingly? Or are you going to be the person who waited for a better entry that never came while institutions captured all the gains? All right, let's quickly recap the RICE method so you can start positioning yourself alongside institutions today. R, recognize the opportunity. XRP has regulatory clarity, $1.23 billion in ETF inflows, shrinking exchange supply, and institutional accumulation happening right now. This is the biggest XRP opportunity since 2012. I, institutional positioning. Think like the smart money. They're systematically accumulating between 1.80 and 240, removing tokens from circulation, and positioning for 3 to 5 year holds while XRP becomes financial infrastructure. S, smart accumulation strategy. Stop trying to time the perfect bottom. Use systematic buying in predetermined zones, proper position sizing of 2 to 5% of your portfolio, and dollar cost average over time to remove emotion from your decisions. E, exit strategy and long-term vision. Have predetermined profit-taking levels at $3, $5, $8, and hold a core position for the $15 long-term target. Never sell everything at once. Ladder your exits to maximize gains while managing risk. Here are your next steps. First, determine your XRP allocation based on your risk tolerance. If you're conservative, start with 2% of your portfolio. If you're more aggressive and understand the risks, you can go up to 5%. Second, set up your accumulation schedule. Break your total allocation into 6 to 8 smaller purchases and start buying systematically in the zones we discussed. Don't wait for the perfect entry. Institutions certainly aren't waiting. Third, Write down your exit strategy before you start buying. Decide exactly how much you'll sell at each price level so emotions don't override your plan when XRP starts moving. If this video helped you understand how institutions are positioning for XRP's next move, smash that like button and subscribe to the channel. I analyze institutional crypto movements every single week, and you definitely don't want to miss the next opportunity. Hit that notification bell, because YouTube doesn't show you every video unless you do. I've got some massive XRP updates coming this week that could impact your positioning strategy. And if you know someone who's still sitting on the sidelines while institutions accumulate, share this video with them. The RISE method works, but only if people actually implement it. Now, before you go, here's your legal disclaimer. Nothing in this video is financial advice. I'm not a licensed financial advisor. This is educational content for entertainment purposes only. Cryptocurrency investing carries significant risks, including the potential loss of your entire investment. Only invest what you can afford to lose, and always do your own research before making any investment decisions. XRP's price can go down as well as up, and past performance doesn't guarantee future results. The institutional data and price predictions we discussed are based on current market conditions that could change rapidly. That said, the institutional accumulation is real. The ETF flows are real. The regulatory clarity is real, and the opportunity is real for those who understand how to position themselves properly. The institutions have made their move. Now it's your turn to decide whether you're going to RISE above the noise or watch from the sidelines while others build life-changing wealth. Thanks for watching, and I will see you in the next video where we're diving deep into exactly which XRP ETFs institutions are buying and why. Don't miss it.